Jeffrey, when you get ambiguity like this, what do you do?
Well, it's a really interesting report. I think you guys have broken it down well, that it may not be so ambiguous when you look behind the headline. The headline is the disappointment on 210, but as Mike McKee just went through, a lot of that looks like seasonality and the impact of seasonal flows coming in lower than what the seasonal factors would otherwise expect. And so you get some disappointment on the headline. As Jonathan just went through, the initial market reaction is all the machines looking at that headline number. Give it a minute and you look at what Lisa talked about, which I think is the much stronger message here, the decline in those unemployment rates, the impact of labor force participation finally coming back. This is the strength of the underlying labor market that is speaking here. And I think when you look at the market reaction kind of fading that initial disappointment is spot on. And that's really the bigger message. And Tom, to your last point, I don't think this report really changes anything from the Fed with regards to the labor market. But it is obviously the cross currents between the headline and the underlying components. I think the underlying components here are much stronger.
Jeff, we've got to talk about the Fed. When they get together on the 15th, it's not just about the taper conversation. Let's discuss their forecasts. Year-end next year, they've got unemployment at 3.8%. Jeff, we're almost there. We're at 4.2. How much of an adjustment do we need to see in a couple of weeks?
Yeah, we could certainly see the adjustments come down, as they keep pace with how rapidly the labor market is improving. I think they're closer on the jobs front than the other forecast, which is of course the big topic, which is their inflation forecast. And I think that's going to be the driver into December 15th. And of course, the other big story, the elephant in the room here, is that this report, doesn't have any of the COVID, any of the Omicron issues that we still have in front of us. So over the next 10 days, we're going to find out a lot more. That's going to drive that debate into the Fed meeting on the 15th.
Jeff, I would agree with you that the underlying components are much more interesting and point to a very strong report aside from that headline miss. I am, though, confused by average hourly earnings and how much we're seeing wages increase. That was a disappointment. And to me, it actually fell in terms of the pace of wage rises from month to month. What do you make of that?
Yeah, it's hard exactly to know what's going on there. A lot of the month-to-month variability, Lisa, is confusing based on the shift in the underlying mix of who's coming in, who's coming out. So when you look at average hourly earnings as opposed to other measures like employment cost index, what you end up seeing is, a measurement of two things. What's the change in who's coming in and out, and what's the change in what they're getting paid? And so when you have more lower wage workers entering the pool relative to higher wage workers, it can push down what you see in average hourly earnings, even if what we think of as kind of a fixed pool of workers, wages are going up. The message on those fixed pool metrics have been for a while now clear that we're seeing pricing power come back to wages. And I don't think this disappointment on average hourly earnings should be overly interpreted as kind of challenging that story. I think it's still a strong labor market with strong labor market pricing and wage inflation.
Jeff, I want to talk about systematic and your responsibilities at BlackRock, and I don't care about systematic to 12/31 or even out into January. How are you managing and allocating capital out to the middle of next year, say the July 28th Fed meeting?
Yeah, this is a really good question, Tom, because what we're really debating is, the bigger picture away from today's report is the Fed is talking about accelerating the pace of tapering, which is so that they can accelerate the pace of tightening. And markets have priced that in, so a lot of that changes with us. The bigger change that we all have to contemplate is the impact on real interest rates. You've had a spectacular level of support for asset inflation across all markets, whether they be financial markets or otherwise, from exceptionally low levels of real interest rates. And the Fed is basically saying it's time to change that outlook. So we should expect a very different financial market outlook in an environment where Fed policy is reacting to the exceptionally accommodative settings of negative real interest rates. And so that challenges a lot of investment returns that we've seen, investment portfolio strategies. And so we're looking at, where are their vulnerabilities and where are their opportunities in a rising real rate environment.
I just want to point out that as we speak and as traders parse through this report, 2-year Treasury yields have turned positive on the day, I should say. Once again, 0.6171%. People assessing the underlying components here and seeing a very strong report. Jeff, with respect to Fed hiking, how many rate hikes can this market withstand and not be disrupted from a risk asset performance perspective?
Really great question, because look at what the bond market is telling you with this massive curve flattening, right? So it's a very clear message from the bond market that it can't withstand that much increases. So what you see priced into bond markets is an expectation that the Fed is going to do what they're telling you, increase the pace of rate increases. We've priced in from 1 hike in 2022 to 2 hikes. So it's not a super aggressive increase. And when you look further out, you see that that pace of pricing in of interest rates by the Fed starts to fade relative to the Fed's dot plots. And that is reflective of the expectations that the market, financial market conditions tightening, the impact of rising real interest rates just can't handle as much of a normalization of interest rates as the kind of full trajectory of Fed normalization in the dot plots otherwise would say. And that flattening of the yield curve, is a message that we should pay attention to. It's basically saying as you move into an aggressive Fed tightening policy, that the impact is going to slow the economy, tighten financial conditions, and is a warning of a recessionary indicator. Whether the Fed goes there, we'll see, but that's what the bond market is saying.
Okay, I agree the bond market's saying that, but very quickly here, Jeff Rosenberg, as we move on to the equity markets, the ambiguity of today's report, does it change the path or the belief, the cadence of taper to tighten?
I don't think it does. I think that, and as Lisa just highlighted, the turnaround in the 2 years, I think the market figuring out that this isn't is not a disappointing payroll report that takes the Fed out. So I think the pace is, as the market, the narrative is still the same, pricing in the acceleration. Now, how far the market gets ahead of the Fed, or whether the market can push the Fed to go even further than that, is kind of the next phase. We've priced in basically, 2 hikes in 2022, accelerating that first hike to June or July of next year. Will we get more? I think we're going to have to see more data, more worries from the Fed on inflation, and a willingness to be more aggressive before we get there.